The only school that teaches you about money is the School of Hard Knocks. Until now.
You need to learn this business, and this is the time to do it.
Become an insider. So you have to know the rules before you get in the game.
Welcome to the Money MBA Podcast.
Oh, have I got your attention now?
Where you'll learn how to be a master of money.
There's so many ways to make money today.
Let me show you in 2 seconds flat why the rich get richer and the poor get poorer.
Now here's your host, Jon Kutsmeda.
Welcome to the Money MBA Podcast. We're back here, part 2 with Tavi Costa of Crescat Capital. Please be sure to check out the first part of this interview. But without further delay, let's get right into it. We've been talking about a lot of things, very much gold-related, recession-related. We continue that conversation here. I really enjoyed speaking with Tavi, full of knowledge, full of wisdom, and hopefully we can have him back on the show in the future, because clearly, as you can tell from both part 1 and here in part 2, we're just hitting the tip of the iceberg of all the information Tavi has to share. So let's get started with part 2 of this interview on the Money MBA Podcast.
The point about recessions that I was making is look at what happened last week now or this week of a downward revision of the Bureau of Labor Statistics on non-farm payrolls. It was a 500,000 downward revision on that number.
How did they get it that wrong? I mean,
that's normal actually. Usually that's why recessions are lagging indicators, is because you got to watch for the revisions. We could be in a recession in the first quarter of 2019. We don't know. Those numbers might all get revised. Unemployment rate might get revised higher. We don't know. That happened in 2008. The last time we had such a large preliminary revision, downward revision, was in November of 2008. For instance. So, you never know when maybe, we definitely see some deteriorating macro indicators in general and fundamentals in companies. And so the data is there as far as some problem. What is not there is asset prices that keep going higher, and investors keep saying that, and maybe, the money is going to continue to fly towards equities because there's no other game in town. I think there is one game in town, that's gold. And some people may say, well, there's Bitcoin too, and there's treasuries as well. You can create a portfolio kind of diversifying on those what you consider safe havens. And in our view, gold deserves a higher allocation to it right now. And then, it's being it's playing out in a very interesting way for the last few. Why is gold rising that way? Is it really because the Fed is easing, or is it because we're pricing a higher probability of a downturn in the economy? I take the latter. So I think that's what's happening. But anyways.
So you have you mentioned a couple of times the capital inflows, the flight to safety, international investors and just money around the globe coming to the U.S. looking for a safe place. And really, in some way or another, it needs to convert into dollars, which is a big part of this liquidity crisis conversation, which is just bullish for the dollar, which, if you really take a step back, again, trying to think ahead, as you do as a macro guy and as a fund manager, this is going to put pressure on equities because you're going to have a stronger dollar, which is really Trump's whole thing. He's trying to boost the economy by doing his own version of a currency war. And you can't fight the hand of the market if everyone's rushing to the dollar. And there's tons of really smart minds in finance, like Raoul Pal and whatnot, who've been making this bullish dollar case for quite some time. And that this liquidity issue or the strength of the dollar is going to be one of the things that really end up breaking the market. And so I think that plays in well to your point about, the business cycle, where we are in terms of equities, the potential for a bear market in equities. But the thing that's funny with gold, at least in the US, up until recently, we're now at a 6.5-year high. I think it closed out just above 1,500. It feels like, and there's a lot of arguments for it, like gold has just been hammered and manipulated low for so long. And I think the mistake a lot of people make when you have this debate about gold and the equity markets is that they're always looking at it strictly in dollar terms. Do you guys take I would assume, a more macro look, and have you really taken consideration of how dollars performed in these other currencies as a signal?
100%. And I actually subscribe to that view of the squeeze on the dollar, short squeeze on the dollar. I think that's a very interesting thesis, and we're long the dollar and we're long gold. We meet with this Chicago professor, Kevin's professor, every year, and one day he said to us, he was like, "Well, how can you be bullish on gold and not bullish on the dollar? I mean, those things don't go together." And I was like, "Well, that's a very conventional way to think." And I started really thinking about that. I was like, I think that's wrong, actually, because I get the idea of it, obviously, but if you're very bullish on things like the dollar versus the yuan, you can have a play on gold, and that's exactly how you play this gold and renminbi terms play. Actually, for that to play out, either gold prices have to rise or the dollar has to appreciate versus the yuan. That's very clear. That's math. And I think that's gonna be the play. So it's kind of like the same idea of being long gold and selling stocks. You don't know the driver, but I truly believe that this ratio is going to go higher. So then you got to think about, how do I position that in the portfolio? Are there ways of really taking a more of an asymmetric bet on one of the two? When you're thinking about gold and being long the dollar, I can't think of a better way than doing that with, let's say, Hong Kong dollar, right? I mean, it's so cheap given the low implied volatility of betting against the Hong Kong dollar, because it's a peg currency, that it's easy for you to really implement that in a portfolio, be long gold in dollar terms, and also be long the dollar versus the Hong Kong dollar. And that, if there is a depeg of that, then gold in Hong Kong dollars will rise significantly. So, that there are easy ways or cheaper ways, or nothing is easy, but there are cheaper ways to implement those trades. And I think that's really where the more realistic view of the world has to come about. Some people have really interesting thoughts about what's going to play out, but as a money manager, you got to think, well, how do I play this, right? I mean, a good example of that, you said about gold being down for so long. We've been in touch with so many money managers that like gold stocks for a long time, and I have a feeling that whole industry is just depressed. I mean that in a big way. Like, here, you talk to them, you can tell that they're happy for the performance in the last 2 to 3 months. But there are so many slap in their faces of like this 2 to 3 month bull market, and then things fall apart again. Those guys have no belief in themselves, and I kind of know how that works. And I listened to their stories, and I'm like, I hear you, and I share the frustration of being down for so long because of more of a macro setup that was never really favorable for gold and precious metals. But I think we're changing that. And when I look at, let's say, mining stocks, for instance, I kind of created this cycle for investing in those companies. Meaning, when I say me, I mean Kevin and I, looking at those companies that really have very good assets. The EV, their reserves are really actually higher than how much they're being priced in the market today. If you have a belief that gold prices and silver prices are going to be higher, and a lot of those investors are actually they're very wary of investing in those firms, because they know they generate negative free cash flow. Those guys are probably not going to. But I think the whole industry is going to get consolidated. The big dogs are going to come in and buy those assets because they're so cheap. And I think that's the first move of the bull market in the mining companies. If I'm right about this change in precious metals, and we're going to go through a bull market 2 to 3 year bull market here for those for the entire sector. I think that the mining stocks that we should be focusing on at the beginning are the not the best, the most profitable companies, are the ones that have the good assets, are the ones that probably not making money because they can't scale the business yet. But what if somebody else comes in and buy them out at a higher premium, and then and that the whole business now becomes scalable and starts working out? I think that, and then you shift towards the more profitable ones, the ones that prove to be more profitable, the ones that really prove that their management system is able to make a wonderful asset to become profitable for a long period of time of mining that reserve or whatever that is. So we've been focusing a lot on that. So understanding, what the past was, for the last 8 years, those guys have been in a bear market. Some of those companies are down 80, 70% from their peak in 2011. It's actually sad, right? I mean, you just look at those investors, you're like, wow, my gosh. But I actually think there's a lot of opportunity on the very supposedly not the nicest companies in a more profitable world, but I think those companies are going to do really well. They're going to be the first lag of this bull market, if I'm right. And then the second part is going to be the more profitable ones that prove to be good are going to be the ones that you're going to be more involved, the royalty companies and so forth. So I went on and on so many things, but I know. I want to let you continue, but there's something you said that I think is really valuable, at least for me. I think it's exciting to talk to macro thinkers because they can see the world where everyone else, it's a blur, right? And they're able to kind of catch these bits and put something together and start to build a theme, a thesis, a narrative, whatever term you want to use for it. And that's great to listen to. And I love getting my mind blown by all these thinkers and like, oh, wow, I never even thought about that. And then you start to kind of get into the vortex and you start to see it for the first time yourself. But like you had mentioned, trying to time the recession, what you're actually looking for is a bear market. And I think this is great because oftentimes we're so fixated on just the number, right? Like what's the S&P today? What's the Dow Jones today? Or what did gold trade at? Same thing with the gold argument. Your indicator is not necessarily the price. It's helpful. You're seeing some momentum. You can build charts around that. And I love charts as much as the next guy, but I think it's a really cool way of approaching this. Although you're a macro guy, you kind of are taking this bottom-up approach to looking for or identifying the indicators, which in the mining world or in the gold world is you want to see consolidation. Maybe when you start to see that consolidation, that's really, the rocket's about to take off. It's great to see what gold's been doing, but it's done this so many times. Like you said, the sentiment in the industry is just, oh, woe is me. I'm just going to get slapped down again. And so you're really looking for that. What's that one other factor that's going to make this time different? Not to use that cliche, but yeah, it's the potential for some sort of fundamental or bottom-up change, right? Where there's this CapEx reinvestment, or there's a merger, there's this consolidation that makes that industry more efficient again, at the same time that the macro narrative is now being supportive because all these other factors are changing. So I'm actually writing down here so I don't forget, because it's a good question in terms of, and it goes back to that bottom-up approach versus a global macro, more of or top-down approach. You can research as much as you want on a gold company, but if you get the gold price wrong, you're wrong, regardless. I think there's only one company that was able to actually be up, significantly throughout this bear market, and the gold mining stock, Kirkland, was a good stock. But it's very rare to find, companies that do well in a scenario like that. I mean, they're actually profitable. I'm just saying you got to get underlying security, meaning gold, precious metals, move right. If you're wrong on that. And so why is this time different than the 8 years ago? Well, first of all, we go through phases, and those people were betting on gold after gold went from, when silver went parabolic. I mean, and until 2011. I hope I'm never going to be betting on anything that is going parabolic like that. I'm never going to be too involved on something like that. I'll probably I'm probably out already on that trade probably. But so I think that's a big lesson is and it's a thing that I struggle a lot because I'm relatively young versus other guys, and I have to rely on the data, not on history of remembering what happened in 2000 and in 70s, 80s, whatever. But data is available, and I can really dive into that and see how those bull markets are really sustainable or not, and what are the macro indicators that were kind of flashing at that time that kind of alarm you. Hey, there's a bull market coming for gold, or there's some signs of inflation here. Inflation, the whole part of inflation is just a cherry on top, really. If we do have inflation and gold prices rise because of that, great. But if we don't, just the fact that nominal rates are going lower, which have a very, very high correlation on an inverted basis versus things like gold. I think, like you said, well, I think that gold, the yields are going to go a lot lower, probably go back to zero, whatever. If that happens, well, that's positive for gold. Negative interest rates, that's positive for gold. But what about this belief now that is kind of awareness of global monetary base kind of debasement theme? I think it's kind of surging now, and if that really starts to become more knowledgeable around people in general, I think that's the gold is ultimately the asset that has history that people can rely on. If you're a pension fund, you can't put a large amount of your money into something you don't have history that you can't really rely on. Like, I don't want to pick on any other asset but gold is the asset that actually has that all those fundamentals and characteristics that those companies can really allocate capital towards that. Pension funds are barely allocating capital towards precious metals today. We could see that changing quite a lot in the near future here. So I think that's a major part of it is the lack of allocation on investments like that, is the lack of trust that things are not going to be. This is not going to be another bull market. It's just a 2 to 3 month bull market that fades. Is the actual disbelief on the people that actually have belief in the whole industry. You talk to those guys that have been managing money for gold companies in general. You can hear their frustration in their voices. It's sad. I'm like, man, I hear you. I think you're going to get it right this time. Right. I really do. So anyways, I think there's so many, not just psychological signs, macro signs, and just fundamentally, I think it makes a lot of sense that there's no way around it, especially if we do have an economy going south, let's say. It's going to be, this is a very apolitical view in terms of elections and all that. What's going to happen with elections is important, even for gold. Very likely we're going to see, a change in political environment here if there is a recession. I mean, it's very hard to see a recession coming in and no changes in the party here. So I think that's going to be a big change in the macro environment, but not just that, but like, what does that mean for precious metals? And, it could be very positive and very negative for risk on assets, by the way. It could escalate some issues here, but especially depending on type of leadership we might have in the following years. But anyways, I think that one thing I wanted to say, I heard your podcast interview with Raul Pal, and I thought one thing Raul Pal said there that I actually relate a lot to that is he said that he was able to build real vision because he doesn't come from that industry, and he was able to kind of disrupt in a way that it wasn't a more conventional way. I see the same way with myself in terms of the industry. I don't come from Ivy League school. I come from studying really hard data and going back and understanding what worked and what didn't work in paper, meaning I don't care if a famous person who got Nobel Prize wrote a nice paper about whatever. I want to make sure that works for investors and that it's actually a implementable way in a portfolio in general. So understanding that, and it's all comes about creating those charts of maybe a more simple way of looking at the world. Right. And being so complex is, you don't gain anything in that business. I think it's even hard to translate your views to investors in general. I just want to make that point of being a disruptive, but not coming from a more conventional way of coming, which most people in Wall Street, I would say, come from.
Well, I appreciate that. I'm glad you listened to that interview, and thanks for referencing that. You, as well as the other people that I've interviewed or at least posted the interviews with, I think represent. It's great that you share that point about you, because I think you represent, and myself included, this uprising of people that don't come from the establishment, and that's allowing a lot of great thinkers to, because the data is available. And I think that, I'm primarily in the real estate field as a profession. And one of the things I always try to tell people in our industry is, there's going to be massive consolidation. You're going to be replaced because your value add to the market before was the data, right? And you had this monopoly on the data. Now the data is public. It's all over the internet. Anything you want to know about the property trends, the property's history. So if you're a real estate agent per se, you got to really ask yourself, what value am I now providing to the market? And I think in the Wall Street space, you have this argument about passive management, active management, and the active management's kind of gotten slaughtered the last decade because all you had to do is buy index funds. And that works until it doesn't work. But I think people inside that bubble have stopped thinking. And Real Vision does a great job of bringing people like you into the forefront. And there's lots of people that are just outside of the system. Maybe they're autodidacts or self-taught, or they're just coming from a unique perspective. And I think that's going to also drive the change. It's going to drive a fresh narrative. And hopefully it opens people up to these ideas where before it felt like it was a culture that they couldn't be part of, right? It was Wall Street and you guys are just these magical money managers. And it's like, no, I mean, the data's there. You can read this. You don't need to be an expert, but if you're going to sit down with somebody and say, hey, manage my wealth, you shouldn't be oblivious to, the source of their logic and the source of their argument. So I think it's great that you come from that. And I think it's a huge value add to your investors. Now, when you're talking about gold and making all these arguments for it, what's your stance on actually taking possession of the physical gold versus trading the paper gold? I mean, where do you stand? And I guess the one is a bit more of Armageddon type of thing. But where do you stand in terms of that?
Now is the time that the gold bugs are going to hate me. I love the theory, but I think that what's happening here, it's much more of a change in the business cycle than the end of the world. I don't want to think that way. I'm not a perma bear. I just think that the cycle is turning, and I don't think there's no need to act that way. I'm meaning the physical gold thing is interesting. I wouldn't put an enormous amount of my own capital on it. If you want to put a small portion of it, great. We play this in a portfolio through futures, and that's one major part of it, and also just mining stocks in general, and so it's more of the price appreciation bet than holding the physical gold itself. Either way, I mean, if you're right about it, about what's likely to happen in the macro setup, gold prices are going to rise, and if that happens, both ways you're going to make money. The real question is, what are you going to do after that? Are you going to run away with? I just don't believe in that whole thesis. I don't think the world is going to go to hell. I think if whatever the change and we've been through wars and World War I, World War II, and the world didn't go to hell. I mean, I don't think it's going to be that bad. Meaning, I think we can have what people call the fourth turning or a big change in politically speaking, geopolitically speaking, even a war between U.S. and China. I'm not calling for that, but it's possible. What if it happens? But I just think that's the bet on gold is much more of a turn in the cycle than anything else. I'm not betting the world is going to end at all. I think that when the markets turn down and let's say equity markets go below, because it works like a pendulum, right? I mean, and so equity markets usually don't go back to their median or average level in terms of fundamentals. Especially like PE multiples or free cash flow multiples, anything you look at. If we do surpass that, I'm a buyer. I'm not. I don't think the world is going to end. I think we're going to be just fine. I want to buy real estate. I want to buy gold. I want to buy stocks, and I want to be a risk-on kind of asset allocator at that point. But I think that right now, I'm doing exactly the opposite. I'm taking the stance of I don't see the point of buying stocks right now. I think that less juice. Let's say I'm wrong, and there's less juice of performance in equities, and because of this capital flows to the U.S. Given the yields are a little bit higher. Let's say that does happen. What is it called? The milkshake theory. Forgot what's his name? Brent Johnson did. Very interesting thesis. I just don't think it's worth it. The risk to take that stance. But again, that's just my view, and he could be 100% right. I agree with a lot of things he says, by the way. And that's that's the interesting point too of how you see the world, because I feel like the gold bug mentality is definitely thinking that that the world is going to end and we're going to have a completely change, and maybe because of what happened in confiscation back in the in the early 1900s and so forth, that could happen. But I think that the real play here is much more on the asset price rising of those underlying securities and than anything else. And that's where I stand on that.
I think it's great that you make that clarity, because one of the things, taking possession of gold, at a certain point, the question I always ask, and I do have physical gold, but it's not like I have 70% of my wealth in it. But for me, the question is, okay, once you have that, and say the gold price goes up, at the end of the day, what are you going to do? Convert it back to fiat. Yeah. So it's a tricky thing. I mean, you really need to have it pegged as a preservation of wealth, as insurance, and you're not really looking to convert it at all. It really is an Armageddon thing. Otherwise, you just need to play, like you're saying, the macro trends, where we are in the business cycle, and historically, this has been an opportunistic play, and that's kind of how you're looking to position things. So what about from a safe haven standpoint, what is your take? I mean, I know it's not something you're necessarily investing in or advising to, but what is your take on this movement with cryptocurrencies, Bitcoin, when should there be this rally in the dollar? Does the reserve currency come under pressure? Again, this doesn't necessarily have to be an Armageddon thing. So take physical gold, but a lot of these factors, you just had the head of the central bank in England say that, mention at the end of the week, replacing the dollar as a reserve currency. You would think something like Bitcoin would knee jerk to that, but it really didn't. But that's a discussion. You just didn't have central banks throwing daggers at each other like that. But I think everybody can kind of see that dollar strength is coming to a certain extent because of the flow and liquidity issues. And so how do you see cryptocurrencies playing into that conversation, as well as how does that fit into your gold thesis? If it's primarily just a play on the price, where do you kind of see it fitting into the narrative about, the global currency and the reserve currency? I wouldn't say Bitcoin or cryptos today are in an environment that would be the way to go in terms of global fiat changes, I guess. But I guess it's a way of playing that idea of going away, moving away from the dollar being a reserve currency. I think that at some point, fundamentals of the country and the macro situation in the country will matter in a way of hurting the dollar. It's not even unfortunate. I guess the truth is today, in my opinion, is that the fundamentals in the macro situation of those other countries, that you always look at the dollar as a bilateral trade, right? It's the dollar versus whatever. The right. Dollar versus anything else, the yuan, the British pound, the yen, anything. I mean, it's really. I mean, it's not. Those fundamentals of those countries are not looking better than the U.S. at all. I think the U.S. looks fine in terms of that. So that's why I like the dollar versus the Hong Kong dollar and versus the yuans especially. But when it comes to Bitcoin and cryptos, I like the ideology of I share the same concerns about
us trusting, very indebted governments and a paper that isn't really backed by something that is tangible or anything sustainable, like a network that is perhaps becoming more relevant, like the Bitcoin network or whatever that is. The dollar itself is being backed by the fundamentals and the macro situation of the U.S. and also to the rest of the world. The people that only look at the U.S. are very missing the point here. And that's why I like the dollar being the cleanest dirty shirt out there, honestly. But I actually am very close to forming an opinion on Bitcoin, and I think it's going to be a bullish point of view from my end, and then figuring out how to play that in a portfolio is kind of tricky because of the custodial issue. I'm not sure how we're going to have to, if in case we wanted to go there. But I do think that there is a demand for that, and there is also a use for cryptos in general, especially when it comes to the capital outflows coming from places like China and Venezuela and very authoritarian places that need some sort of vehicle that can make that transfer of capital. And gold is not your friend in terms of that. It is your friend, but it's not as much as your friend as cryptos would do a great job at that. Although I think that's an important distinction between the two. But I'm trying to really understand the whole crypto play, and I don't fully understand it yet. I've been spending a lot of time on it, reading papers and just trying to aggregate data. It's very hard to find data for it, which is, for me, it's kind of a problem. And I've been trying to understand, the whole network idea is the one that is probably the most valuable one, but understanding, right, are people buying those things and holding? Are they buying and selling? Is this really a transaction network or there's so many ways you can look at that. For me, crypto does serve does have a purpose for, like I said, for those capital outflows today. Now, I don't know if it's going to act like gold. I mean, it's so hard to do that. I think that if you're going to bet a small part of your portfolio on that is probably not a bad idea. I'm not doing that today, but I don't think it's necessarily a bad idea. It could be something that could double and triple, and right, probably why you don't need to size it so high. Anyways, I'm not an expert of crypto, but I share a lot of the issues that the community and the crypto industry share, and I think that they're ultimately right about what's happening in with central banks in general, and what's the right way to do in terms of going back to a gold standard. I think we're kind of far from all those things. Thinking in 2 to 3 years from now, I don't think we're going anywhere close there in the next year or so. So I'm not too focused on that. I'm obviously following and I have an opinion, but I don't think it's going to change much of the macro environment in the next year, at least. I think it's much. I think the more important part is the cycle turning. I think that's really where my emphasis really is of my time. But
so with that in mind, the phase we are in the business cycle, the cycle turning, you coming from an emerging market in Brazil. And again, the China story has such a big impact on emerging markets like Brazil and Australia, because they're the ones that have been feeding the raw materials into China. Being part of that or being familiar with the emerging market personally, especially South America, what are some things that you're seeing in these other countries that are reinforcing, number one, your perspective on everything we've talked about so far? Not just in the currency, but in other aspects of the economies, and maybe really going out that 5 to 10 year macro view, demographically speaking, maybe regime change speaking. Do you see any opportunities in some of these countries that right now aren't necessarily the place to invest, but long term have high potential?
Yeah. I think that there's definitely some sort of hype towards emerging markets, at least not in the last week or so, but because of the turmoil. But, for the last, let's say, since the beginning of the year, a lot of investors are speaking very highly of places like Brazil. And I understand the difference of valuations of companies in general, especially like CAPE ratios or PE ratios or any multiple you look at. Brazil looks really cheap, for instance. I'm going to pick Brazil here because it's the one that I look the most. And for me, you have to look back in history and see that that's actually true, but it's been true throughout the whole history of Brazil. If you would have bought Brazilian stocks in 1990s and converted that back to dollars, and the return converting back to dollars, and you would have bought the S&P 500 as well, you would have made a lot more money in the Brazilian stocks, believe it or not. Actually, almost double the amount, or more than double the amount of money. And that's considering a huge currency crash that they had in the early 90s in Brazil and so forth. Meaning Brazil, has a lower multiple, but usually it's a riskier, play as well. I mean, if you think that the emerging markets world, meaning the commodities world and China are going to be, their economy are going to be prosperous in the following years, I think you got to have a bullish view on Brazil. But if you don't, like I'm in that camp, it's really hard to find of the bullish thesis supportive here for Brazilian stocks. So saying the Brazilian stocks are cheap today, if you look back in history, they've always been cheap, meaning they've always been kind of value lower multiples because of the risk of political risk, economic risk, and not being as good as an economy as other places. That's kind of obvious. So that argument, I don't buy that at all. I think somebody has to really look into the big macro picture, and if you have, unfortunately, if you have a negative view, a negative outlook on China, then I think that has to have an impact in Brazil. But when I talk to Brazilian investors and Brazilian friends that are actually investing in Brazil, I see this, which I'm not a fan of that, of this, like I know everything, this hubris of the Brazilian stocks are going to go higher regardless, and you don't know what to do. I mean, I hate that hubris at all, because nobody should have that hubris towards anything. I don't know what gold is going to do in the next years. I mean, I just have a high conviction on that. I could be completely wrong. Having hubris is one of the worst things you can have in terms of attaching your emotions to an investment. I see that happening quite a lot with Brazilian investors in general, and it's sad because I think they're going to get burned in some point of their lives. I don't know with Brazilian stocks or whatever that's going to be. And you can ask that question to a lot of investors and successful investors. They share similar ideas. I would say that, having a very strong opinion is important, but don't let your hubris or your emotions really play a big role in that view. So long story short, I don't think that the emerging markets are going to have are going to be the answer here. They're not going to be separate from the rest of the world. If the world goes south in terms of economic growth, I don't think Brazil is going to be going a lot higher. But I'm obviously interested in a lot of places that have had a very long term of or last 5 to 10 years of very negative growth. Some places in Europe, I guess, look kind of interesting. In Brazil, at some point, I think Brazil is going to look really great. But I think the problem in Brazil here is the currency. I think the currency is going to devalue significantly. If the yuan devalues, I can see the Brazilian real going to 5, going to 6. Right now, it's at 4 point something, and it's going to look ugly. That usually drives inflation higher. Historically, I've done a lot of research on correlations of the depreciation of the Brazilian real versus inflation, and that drives inflation higher. If drives inflation higher, that drives yields higher. It's a very different scenario than the U.S. I mean, the U.S. haven't had inflation in a long time. Those countries have lived through inflationary periods for a long period of time, and inflation is almost like a bug. When it bites you, you have that issue for a while. The U.S. had that for over a decade. And then it fades and then it goes away and nobody talks about it. Like in the US, nobody talks about inflation anymore. It's like this, inflation is not a thing. Yeah, it's not a thing until it is. Right. And then when it comes back, again, it's like a bug, and then it bites everyone, and everyone is in trouble. And it's it's sad because I can go on and on this inflation theory, but at least in Brazil, we're still in that situation. The inflationary scenario is still the case, and if there is a depreciation of the currency, that problem can go back in a heartbeat. It
can ignite it pretty quickly. So it's, I guess it's the most simplest thing anybody who's invested or never invested knows. You buy low and you sell high. So through all of this, if we see the dollar skyrocket, and against all these other currencies, the Colombian peso, the Chilean peso, the real, Australian dollar, at what point do you sell the dollar and start looking into these other economies as a place to be buying really, really cheap assets, whether it's businesses, whether it's real estate, stocks? Is that something, again, I know we're playing in the hypothetical, but is this something that maybe you're kicking around as okay, what happens when all of these things that you're talking about play out? The dollar rises, gold rises, all these other emerging economies kind of go down the toilet with the rest of the global output. At what point do you start thinking I should pivot and look at these other markets?
Well, I think if there is really a secular shift in terms of the dollar being the reserve currency and the real, growth engine of the world, just like China, if that shifts, I think that's obviously going to be a very bad for the dollar. I don't think we're there yet. If you look back in history, there are periods when a recession or a bear market is unfolding, and at the same time, the dollar is rising. Why? Well, because people buy treasuries, and that drives the dollar up as well. I kind of, that scenario could be possible again today. And why I wouldn't also, treasury is a very tough, if gun in my head, I would be bullish, and I am bullish right now in the portfolio, but it's not things could turn all the way very quickly in terms of I'm just saying the scenario for higher interest rates makes a lot of sense as well. So it's just like the flow is really causing that to become very attractive as a trade, and that has been the case for the last two changes in the cycle. That was a very useful way of protecting your money. But I don't see in the short term, going back to your question on the dollar, I don't see why the dollar wouldn't rise in any scenario here going forward. If there is a situation like Brazil, the U.S. is the next Japan kind of situation, because yes, betting against Japan has been a tough trade, but betting against the Japanese yen has been a great trade. There is no way around it. If you're going to dilute your currency, it has to devalue. But people give Kyle Bass, for instance, a hard time of getting wrong Japan. I actually don't think he got it wrong at all. I think he got that part of, the part of the bonds was perhaps a little bit off, but that part of, not a little bit off, but the part of the currency, he got 100% right. The currency devalued over 30% from peak to trough. And that's, for me, that's an important part of the thesis, because if you're long JGBs in yen, did that work out well in dollar terms? Probably not. I'm just saying, that part of the trade it was a major part of the trade worked out really well. And I think that's, when you're doing things like I do in terms of like picking really good pair trades, sometimes one may not be the driver, but the other one can really drive the performance of the whole investment. So I think that the dollar right now still looks attractive, and I think it will look for the next year or so because of what's happening in China and this kind of, unfortunately, I think there's quite a lot of investors that still think that there's going to be this change of the reserve currency in the short term, and I don't think it's going to happen that way right now. Probably if I put out a poll right now on Twitter of that, you see that that's a very conventional thought that everyone thinks it's going to happen sometime soon, and I don't think it's going to happen right now because of the implications of assets being denominated in dollar and how large allocators, pension funds, and so forth, they still they have mandates to have to hold assets in those terms, and that's the part that is tricky, I think. So I think that's all a little bit down the road. I still, I'm happy to own dollars right now, and I think dollar is the best alternative for fiat currency at the moment and for the next year. And then we'll revisit that if there's more signs of a secular shift, not just a secular shift, but of short-term signs really showing that maybe yields are going higher. That would be a bad sign for the dollar, right? Because that would be, if yields go higher here in the U.S., that would be sort of driven because of the amount of debt imbalances we have in the system and all that. And I think that and really the problems with the political situation in the U.S. and all that. If that causes yields going higher, then that would be a change in the whole thesis of maybe people are going to be going away from the dollar, and that's kind of an interesting shift. But I don't think we're there, and if we are there, I think it's easy to make that change. And being long precious metals will do really well in that scenario too. So I'm happy holding that at the moment.
So that transitions me into the last thing I want to ask you, which is all of these things you've been talking about, gold, China. We really have been looking at this, I think, quite well from a macro viewpoint. And you just addressed a question I had about the dollar and potential dollar regime change, or at a certain point when dollar is really strong, are there other opportunities? And your response to some extent was, when there's other signals that, whether it be inflation or weakness in the dollar, and you're not necessarily bullish long-term on treasuries, which I would assume probably has a lot to do with the amount of debt that the U.S. has. The U.S. is one of the most indebted countries in the history. That's one thing I think U.S. and China has in common. And with that in mind, this is also, I think, part of your theme or thesis with the equity markets and the potential of a business cycle shifting here, because you have so much debt in the system, not just with governments, but on the corporate balance sheet. You have a ton of zombie companies. So do you want to speak to some of the issues in the credit markets, or at least the excesses of credit, and how that kind of supports your theme as a way to wrap this up?
Yeah, just a point about the treasuries play is that we're long treasuries in a portfolio, but more on the idea of the convergence of monetary policies between the Fed and the ECB, which I think is a very important point. As their policies become more, they narrow their policy rate, meaning the Fed rate becomes a little, or you can measure that by just looking at Euribor versus LIBOR, or so many ways, just yields in general. But the 10-year yield in the U.S. versus the 10-year yield in Germany. So we're short German bonds, but we're long treasuries on that trade, and has been working this year very well as the spread of those two yields have been narrowing significantly, mostly caused by the treasury side. And again, but it's the only distinction I make of that versus, let's say, a pair trade like being a long gold and short the yuan. I would be happy to be long them by itself in a portfolio with no problem. I wouldn't be happy just having treasuries in our portfolio on its own. That's a different question. When it comes to the amount of leverage in the system in the U.S., I don't see actually a crazy amount. When it comes to like the corporate side, it seems bad, and I think that if there is a change in the cycle, obviously the junk bonds are the next ones, and probably the next shoe to drop. I think is the junk bond market. But when you look at households are not too leveraged yet in the U.S. The government is. So there's three parts of that whole scenario, and I think that one of them is a major one is the households. They're not too leveraged yet relative to other times in history. But overall, the debt in the country is definitely high relative to GDP, and that creates a sort of a scary, thought about how is the U.S. going to be able to borrow money, or how yields are going to play out in the following years. I don't think that's a problem for today, but I think it will eventually become a problem. It's why I'm not taking a short side on treasuries yet. But I think that the biggest play here is there are some kind of interesting ideas of on the short side here of things that are rising with treasuries that make no sense to me, like investment grade bonds. Investment grade bonds have been rising right along with one way to look at that is LQD, the ETF rising. Put that with treasuries, it's the same chart. But the problem is a lot of those investment grade bonds are actually junk bonds. They're not investment grade bonds, as we know, especially on the leverage ratio side, they should actually be denominated as junk bonds. And it's interesting that they're rising. It's in this crazy search for yield of people buying those things. But if the cycle turns, there's no way people are going to be buying that, in my opinion. I think people are going to be selling those things. And it's kind of starting to look kind of interesting. The spread between the LQD and the JNK, or the investment grade bonds versus the junk bonds, is starting to get to levels like it reached in 2009 or so, which is kind of interesting, because back then the spread really caused that spread back then was because junk bonds plunged. This time, junk bonds didn't plunge, is that LQD or investment grade bonds are rising significantly. It's very important to see that difference of what's causing the spread to rise between the two. So yeah, there's a lot of zombie companies in the U.S. and it's probably caused by the easy credit. I made that question the other day in another podcast. Would Uber, the Ubers of the world, really survive in the 70s or the 60s? Probably not. I read that book of Shoe Dog from a Nike CEO, Phil Knight, and it's so interesting. He tells his story about raising capital for the firm in the beginning and how he starts you look at that versus the how easy it is today to raise capital in this environment is just insane. I mean, it's those companies would never survive. I mean, sure, maybe Uber would survive. I don't know. If investors would really buy into that and they would be able to really raise capital the way they've been raising and losing money every quarter. But it's kind of, I'm not picking on Uber itself. I'm picking on the whole private equity. Now it's not private anymore, but the whole private equity industry is there's so many of those bubbly businesses out there that just makes no sense. At some point, we're going to see the price is going to have to really converge with the fundamentals of those businesses, and I think people are pricing in that we're going to have way too many Amazons out there. I mean, Amazon itself was making money in 2000 or so. They had free cash flow positive. They actually did. It's not like they're losing money asking for and trying to raise capital. That was not the case. They had a vision and they were making money. Those guys have a vision that might not even be a realistic vision, and they're losing money every quarter and asking more and more money, and investors just giving more and more money to them. At some point, there's no way this is going to be sustainable. And it's kind of interesting when you hear that it's different this time because of the fact of having negative interest rates, and the central banks now are only going to go easier and easier. At some point, that can't be, either it's going to be inflationary or either it's going to be a bust, that the cycle is going to turn and those companies can raise capital anymore. But there has to be some sort of a go back to earth in terms of liquidity. The liquidity is so high right now in terms of those firms raising capital. You're starting to see liquidity actually dry in the equity markets already here in terms of looking at SPY, ETF, so that's more of a retail investor purchase of stocks. You can see that's drying significantly. Any way you look at 30-day or a few months of average volume of SPY ETF has actually been drying out significantly, which also tends to be to coincide with a market top. And it's kind of interesting. I think we're getting very close here to that third leg of our high conviction themes to start working out. And I think that would really drive performance of our funds.
So to sum it up, we're getting towards the end of the business cycle. Short stocks, maybe buy some treasuries, and definitely look to buy gold.
Exactly. And I think that for a person who's not that sophisticated in terms of buying, like selling the yuan, selling the renminbi, it's not easy to do for every Joe to do that. I don't do it in my personal account. I have to do through investing in the funds. So, if you're in that category, I think that is the best way to play is buying buying precious metals and selling stocks, and perhaps buying a little bit of treasuries. The third, and if you're more sophisticated, I think the macro trade of the century is buying gold in renminbi terms and selling global stocks and the most overvalued stocks you can find. And those are probably most in the US, Canada, and Australia, and some in Hong Kong and kind of China. But those are the ones that I would focus. I wouldn't like short Brazilian stocks. Just because of where, fundamentals are not too wacky in terms of prices versus places in the US. So I think that's an important part too. But looking for the most overvalued ones is a big part of the process. So,
Tavi, thanks for summing that up, man. That was a great end to this fantastic interview. I had a ton of fun. I learned a lot. I really appreciate you taking the time here on a weekend, and thank you very much.
It was a pleasure. I enjoyed talking to you and getting to know you as well, Jon. So thank you very much for having me.
My pleasure. So how can people learn more about you, keep in touch with you, follow you on social media, learn more about your fund?
First one is Crescat.net. Very quick. It's a website. It's easy. The second one would be Twitter. I'm very active on Twitter at Tavi Costa. It's very easy to find me there. And I try to post things almost every day on any of those topics. And so I think it's not too hard to find me there. But
well, we'll put that in the show notes, and hopefully everyone checks you out. And I look forward to having you back here soon. So thanks again, Tavi.
Thank you very much, Jon.
Talk to you soon.
Thank you for listening to the Money MBA Podcast with your host, Jonathan Kutsmeda.
It's also my pleasure to see to it that decent, hardworking people in this community aren't robbed blind by a pack of money-mad pirates.
To access more great content, visit us online at moneymba.com.
That's where the money is. And more than that, control.
There's only one person in the world to decide what I'm going to do, and that's me.
And I am deadly serious about that. That's it. I'm done.